Hey there. Imagine if every citizen suddenly woke up to find $1 million in their bank account. Initially, the idea sounds like paradise, but in a few days, prices skyrocket. Bread costs thousands, rent inflates to absurd levels, and your newly acquired fortune becomes as useless as monopoly money. That's what happens when a country prints excessive money. It's not a miracle. It's a meltdown. The logic seems simple. Need money? Print it. But the reality is deeply complex. Let's dive into why printing money isn't a solution, and how it could actually destroy an economy. Understanding what money really is. Money isn't wealth. It's a symbol of value, a tool for trade, and a store of trust. Think of it like a movie ticket. If the cinema prints twice as many tickets as seats, people will fight for a place, and some will be left outside. The same thing happens in an economy when there's too much money and not enough goods and services to back it up. Printing more money doesn't magically create more food, fuel, or homes. It simply puts more cash into people's hands without increasing the availability of things they want to buy. That imbalance between supply and demand causes prices to soar. The Zimbabwe catastrophe. In the 2000s, Zimbabwe experienced one of the worst hyperinflation cases in modern history. The government kept printing money to pay off debt and salaries. At first, it felt like a solution. But soon, basic goods became unaffordable. Prices doubled every day. A loaf of bread eventually cost billions in Zimbabwean dollars. People used banknotes to light fires because it was cheaper than buying matches. Germany's hyperinflation. Nightmare. Post-World War I. Germany was drowning in war debt. In response, it printed money. Lots of it. What followed was catastrophic inflation. By late 1923, $1 equaled 4.2 trillion German marks. Money was worth so little that children played with stacks of it like building blocks. Citizens needed wheelbarrows of cash to buy groceries. Venezuela's economic collapse. Venezuela's story is more recent. In response to economic crises and plummeting oil revenues, the government printed money to fund public programs. But instead of boosting the economy, it destroyed the value of their currency. Inflation ran into the millions of percent. Shops were empty. Citizens abandoned the currency in favor of bartering, using US dollars or even Bitcoin. So, why doesn't it always happen in wealthy countries? The United States and countries in the EU also print money, but they do it within certain limits and with strategies in place. During COVID-19, the US printed trillions of dollars to support businesses and workers. Yet it didn't spiral into hyperinflation. Why? Because trust matters. The US dollar is the world's reserve currency. Investors believe the US will pay its debts. There's also a strong central bank, the Federal Reserve, managing monetary policy. But even in the US, inflation spiked in 2021 to 2022 due to supply shortages and increased demand. It's proof that even strong economies feel the pressure when too much money chases too few goods. How inflation actually works. When demand goes up but supply stays the same, prices rise. This is the core of inflation. Money printing increases demand, but unless production rises too, the system gets strained. Inflation reduces the purchasing power of money. If you had $100 yesterday and inflation is 10%, today it buys only what $90 could. Over time, this erodes savings, wages, and living standards. Loss of public trust. Money functions on trust. If people believe their currency will hold value, they use it. If that trust breaks, the system collapses. People rush to spend money before it loses more value. This triggers even faster inflation. Confidence drops, and an economic death spiral begins. Interest rates go up. Printing money can lower interest rates initially because banks have more to lend. But over time, Investors demand higher returns to protect against inflation. That raises interest rates across the economy, making loans and mortgages more expensive. Growth slows. Business investment shrinks. It hurts the poor the most. The rich can protect themselves with assets, stocks, real estate, gold. These tend to rise with inflation. But the poor, who spend most of their income on food, rent, and transportation, are hit hardest. Essentials become unaffordable. Inequality grows. Social unrest follows. Can printing money ever help? Yes, but with strict conditions. If used to fund projects that increase productivity, like infrastructure, education, and healthcare, it can create long-term economic value. But the key is balance. If output doesn't rise with spending, inflation kicks in. Modern monetary theory. MMT. Hope or hype. MMT says governments with their own currencies can spend freely until inflation shows up. Deficits don't matter until the economy hits capacity. The theory suggests money can be printed to fund programs like universal healthcare or green energy. Critics argue this underestimates inflation risks and assumes too much control over economic psychology. While it provides interesting tools, unchecked money printing remains dangerous. Japan. An unusual case. Japan has printed money for decades, yet it hasn't faced runaway inflation. Why? Because demand is low and people save rather than spend. An aging population, deflationary trends, and tight control over currency flows make Japan a special case. But it's the exception, not the rule. Digital assets and limited supply. Bitcoin's appeal is that its supply is fixed. Only 21 million will ever exist. Supporters say it can't be inflated like fiat money. But Bitcoin is highly volatile and not widely accepted for everyday use. While it illustrates the value of scarcity, it's not a complete alternative to national currencies just yet. The real path to wealth. Instead of printing money, nations build wealth through increasing productivity, investing in infrastructure and innovation, educating the workforce, encouraging entrepreneurship. These are slow but stable paths. They expand the economy without eroding trust or purchasing power. What happens if we ignore the risks? Unchecked printing leads to a cycle. 1. Prices rise. 2. Wages can't keep up. 3. Savings lose value. 4. Foreign investors flee. 5. Currency collapses. Eventually, the government has to reintroduce a new currency or dollarize the economy, like Zimbabwe did. So, what should governments do? Smart fiscal policy, sustainable investment, strategic debt management, encouraging real economic growth instead of artificial monetary boosts. Central banks must balance stimulus with stability. Conclusion: printing money sounds like a simple fix, but it's not. It's a temporary illusion that leads to long-term damage. Money only works when it's backed by trust, goods, and services. Real solutions require building, not printing. Productivity, innovation, and infrastructure are the true engines of prosperity. That's why, no matter how tempting it seems, we can't just print more money. Money isn't magic, it's management, and mismanaging it can break entire nations. Next level insight: the domino effect of overprinting. Let's go deeper. When inflation rises, central banks respond by increasing interest rates. This makes borrowing costlier. Companies delay investments. Unemployment rises. Consumers spend less. The economy slows. That $1 million injection? It ends up shrinking growth instead of expanding it. Currency devaluation and import troubles. When a country's currency loses value due to overprinting, importing goods becomes a nightmare. Every barrel of oil, every ton of wheat becomes more expensive. If you rely on imported fuel or food, prices spike. Domestic manufacturers who depend on foreign raw materials face soaring costs. It's a ripple effect across every industry. Loss of global confidence. The global economy is interconnected. If investors sense a country is mismanaging its currency, they pull their money. The stock market drops. Foreign exchange reserves deplete. The government might impose capital controls, limiting how much money people can withdraw or send abroad. It becomes a financial cage. Case study: Argentina's endless struggles. Argentina has defaulted on its debt multiple times. Why? Because of a long history of excessive money printing and fiscal mismanagement. Inflation regularly hits double digits. Citizens don't trust their own currency. US dollars are hoarded, and black markets flourish. It's not about the printer. It's about production. Economic strength comes from making things people want: services, products, technology. You can't print a successful company. You can't print skilled workers. True wealth is built, not photocopied. Closing. Example: the cake analogy. Imagine a cake sliced into 10 pieces. You print 10 more tickets for a slice, but the cake hasn't grown. Now 20 people want a slice, but only 10 pieces exist. Either the cake gets cut into thinner slices, or people bid more money to get a piece. That's inflation. If instead you bake a second cake, now there's more to go around. That's real growth. And that's what economies need. Bottom line: printing money isn't evil, it's a tool. But like a powerful medicine, dosage matters. Used wisely, it can support recovery. Used recklessly, it can wreck nations. History proves this over and over again. So next time someone says, "Why not just print more?" you'll know exactly why we shouldn't. Real prosperity is earned, not printed. If you want me to make other videos explaining these topics, please like, share, and subscribe.